What's up you guys, Tomy Shaw here, and on today's video what I'll be doing is explain why the rich become richer in 7 key points, okay? So the reason why the rich become rich is because they use tools that help them to become wealthier, okay? So first of all, let's just start with a balance sheet, okay? When you want to become wealthy, you need to learn how a balance sheet works, okay? You have the assets on your left and you have the debt and capital on your right. The right side is to finance the assets, okay? So if you don't have capital, you can get capital from angel investors, capital venture investors. There are many ways you can get capital. You can get it from family, or you could save it by working for somebody else. Once you have capital, that capital is invested. It's either invested in a fourplex, real estate, businesses, an ID, a e-commerce, an online business, anything that can generate income. You could buy equipment. Equipment can generate income because if it's producing 25% return on asset every year, then it becomes an asset, okay? These assets, when they produce an income statement. You could have employees here, you could have intangible knowledge, and this produces an income statement. The second thing you need to know when you want to build wealth, okay? So let's just look at an example of real estate. You have a fourplex, you have many fourplexes, and this is generating you rent. Once you have rents, you have to deduct vacancies, and then you have to deduct all the expenses, the operating income of that business. All the expenses that have to do with running the business goes into your operating income. It could be salaries, it could be paying for the equipment, it could be paying taxes on your properties, it could be your manager. All of these are going into your operating income. It's very important not to put your interest or your depreciation in the operating, because this is another section of the income statement. Then you get the NOI, net operating income, or it could be your earnings before interest, taxes, depreciation, and amortization. Once you have that number, that NOI, you can determine 3 things with that number. You can look at leverage, cap rate, and DCR, debt coverage ratio. The DCR tells you your ability to pay your debt. Your leverage, it gives you an idea if leverage is possible, because if you have a cap rate of 7% and the debt is at 2%, the cost of interest, then leverage is possible. It doesn't give you the amount of real return that you have yet. It only gives you an idea if leverage is possible. And we all know in a business, it's how you structure the company to use leverage to increase your ROE, your return on equity. Now, the last thing, we already talked about cap rate, leverage, DCR. Once we know these numbers, then you have interest, depreciation, taxes, and then you get down to your net income, okay? The rich don't pay taxes because they have a lot of expenses, and then they have interest that they can deduct. They have depreciation, because if you look at a fourplex, it usually depreciates at around 4% per year. So you have, let's say you have $1 million in equity and it deducts by 4%, that means you're allowed to depreciate $40,000 here, okay? So let's say you have 20% down, $200,000, and you have $1 million in equity, that means you have $800,000 in debt. So $800,000 times 2% is $16,000. So we have $16,000 here, and let's say in my example we had $40,000 depreciation. So the company can make $56,000 of NOI before paying interest. It's very important to understand that, because you could use depreciation and you could use interest to not pay taxes, because this is one of the laws of the rich. The rich use depreciation and debts to lower their income taxes, okay? And in this example, I had $110,000 of rent. Let's say it is around $60,000 of NOI. Then you get down to interest, so you have 56. That means you have to pay $4,000 at your tax bracket. It depends, okay? You always consult with a professional. You don't do this by yourself. But this is to give you an idea of how the rich use assets and cash flow to make money. Remember, depreciation is only an expense on paper. It's not a real expense in your cash flows. So in reality, you're paying $4,000 in taxes, but you have to put that $40,000 back when you're looking at the cash flow statement. That's the third thing you need to know. You need to know the cash flow, because which way is money flowing? Is it going out of your pocket or in your pockets? In this example, we have, let's say, $2,000 in taxes, so the net income is around $2,000, and then the cash flow, what we do is we add that $40,000 again. Now we get to $42,000, but remember, you still have to pay that capital. So in this example, $16,000, let's just say that the capital was around 2% also, so you're paying $16,000 in capital, and you're left with around around $28,000. Maybe I'm wrong here, did a mental calculation. Okay, so you have this assets that you're only paying 2% or $2,000 on $110,000 of rent. So 2%, 2,000 divided by 111,000 is less than 2%. So you have 2% income taxes, okay? Of course, you still paid municipal taxes. You still paid all these salaries, all these people's, all these benefits. So like they say it's 2%, but it, in my mind, it's more than that, because when you're paying the municipal tax, that to me is a form of tax, okay? It doesn't look like it's a tax, but it's a tax. So this is why the wealthy become rich, because they have all these tools that they can use to reduce their taxes. And when you look at this, it's natural that this happens, because you wouldn't want a business to take more debts to pay its taxes. In this example, you still have to pay that equity. You still have to pay capital on your debt. So that gives you like a profit, but at the same time, you're at a negative cash flow. So if you didn't have this tool, depreciation, you would have to borrow to pay your taxes, okay? Hopefully that makes sense. I know I'm giving a lot of details in this video, but in one video, you have a general knowledge of how everything is connected together, okay? A lot of people give you a little piece of information here, a little piece of information there, but they don't connect the dots. If you look, assets gives you depreciation. When you have debt, it goes into your interest, and then you pay taxes on whatever is left before taxes. Now, that's one of the forms, okay? Remember, debt and capitals are both currencies. They're both money. So that's why the rich don't care where the money comes from. They look at debt and capital as money. So whatever it takes to finance their business. The second thing I forgot to mention a while ago is that the rich solely focus on assets. They're looking to make this column grow. Why? Because they don't care where the money comes from. Of course, if you have a proper structure of capital, it's going to secure your business. But I'm always looking at least 20% down, okay? Because if something happens with the market, it tanks, and you have zero equity, you could be forced to sell quickly. And you don't want to be in a position where you need to liquidate your building, because if you need to liquidate your buildings, you're going to have a lot less than 20% equity. You're going to be minus something, okay? The rich understand taxes. The more debt they have, the less they pay in taxes. Why? Because they get more interest, and if you have more interest, you have more deductions in interest to pay less in taxes. The fourth point, assets, debts are utilized to lower taxes and increase cash flow, okay? I've just explained that a while ago. Since depreciation and taxes or interest, they both reduces your taxes. In a sense, it increases your cash flow, because remember, if you're not paying taxes and you can add back that amortization or that depreciation on your cash flow, that increases your cash flow, because if you don't have to pay taxes on $40,000, you have more in your pockets to grow your business. And that's the point. The goal of business people is to grow businesses. They want investors to grow, because if you're growing and you have that wealth mentality, you're contributing to society. When your businesses gain value, when you sell it, you have to pay capital gains, and the government gets richer. All right. So 5, the rich utilize inflation to pay off the value of long-term debts, because when you look at it, 2%, and inflation usually is around 2%. That means the creation of money destroys the value of money, because if you create one, you need to destroy it at the same rate. So if you're looking at long-term debts in real estate or your businesses, and you're paying at 2% and you have 2% inflation, that means you have essentially free money. Now, why money is dead? It is only natural that what gets created gets destroyed at the same pace. Let's look at number 6. Assets that appreciate conserve wealth. Most of the time when I look at assets, they usually appreciate at around 4.5%. So if your assets are appreciating and you're using depreciation, that at a certain point you can refinance those properties and buy more. Now let's look at the last point. The last point is that not real flow of money. Expenses that are converted into capital gains. Okay, you can essentially take depreciation, put it into expense, and convert that into capital gains for the future. All right, so that's why the rich get richer in 7 key points. Okay, if you like this kind of information, like, subscribe, and I'll be seeing you on the next video. Thank you.